A lot of talk again this week on India and how its weight is increasing in the MSCI Emerging Market Index. We're seeing the same thing amongst active managers. This chart shows the average weight in India over time versus the average weight in China over time. We can see the two converging, China at 7-year lows whilst India is at record highs. If we focus on India and split the average allocation by fund style, we can see India is very much a growth market. The average weight amongst aggressive growth managers at record highs of 20.6, followed by growth at 17.3, and getting lower as we move down the style spectrum. If we split this by average weight versus the benchmark, it becomes even more visible what the issue is. We can see value managers finding it harder and harder and harder to justify a position in India at the moment. The average value fund weight in India is 10% below the MSCI Emerging Market Index, followed by yield and GARP, and even aggressive growth funds have found it harder to be overweight India at the present time, and we're at 10-year lows in the aggressive growth fund overweight. If we look at India in a bit more detail, we can pull up our India dashboard here. We can see chart 3 shows the average weight as we've seen at record levels of 16.4. The average weight versus the index across all styles is at record lows of 2.8% in chart 5. That's the highest country level underweight across the entire EM complex at the moment. But where's that coming from? Managers aren't overweight a country, they're overweight sectors and stocks. If we look at the sector breakdown in chart 8, the second column here looks at the sector overweights and underweights in India. You can see at the moment active managers are overweight Indian financials by 50 basis points or 47 basis points. If we click on that, we can see that overweight has been in decline. And if we focus on chart 9, the stocks that are driving that overweight, we can see HDFC Bank is a key overweight for Indian investors, still 80 basis points overweight on average. But the underweights are what's dominating at the moment. If we look at the 3 largest underweights of materials, energy and consumer discretionary, materials an 85 basis point underweight was once a 1% overweight, and that's declined. We're at record lows in materials. And again, if we look at the stocks that are driving that underweight, we can see Tata Steel, Ultratech Cement, Grasim Industries and JSW Steel accounting for around about 50 basis points of the net Indian underweight alone. JSW Steel owned by only 3.4% of funds, Grasim Industries by 2.3%. So a fairly unloved sector within India. If we focus on energy, it's a similar picture in terms of the record underweight in chart 5. Chart 9 really highlights that Reliance Industries is the key stock driver of the underweight within the energy sector. And then finally, consumer discretionary, we can see Tata Motors, Maruti Suzuki and Avenue Supermarkets again accounting for another 40 basis points of the underweight in India. So overall, you can see 7 or 8 companies accounting for 1.5% of the net Indian underweight. This is not just a country underweight, it's very much focused on individual companies, and that will affect how active managers outperform in the coming months. If you want access to these dashboards, you can. Please get in contact with me directly or via the Copley Fund Research website. Thank you.